Well, hello, everybody, and thanks for joining us today. Before we dive into our presentation today, we're going to warm up with a little brain teaser about Bill. Sound fun? All right, here we go. So, Bill, his stats are on the left-hand side, as you see. After working hard his adult life, Bill, who's 65, has finally retired, and he's going to more concerts now than ever before. Bill has $41,825 in taxable income, which does include $25,000 or $25,000 of Social Security benefits this year. So he's got $38,000 in IRA income and $25,000 in Social Security benefits. So as you can see, his $41,825 of taxable income puts him in the 22% tax bracket because, as you see on the right, that tax bracket there, that is more than $41,775, but less than the $89,076. So he's right there in the 22% tax bracket. Now, toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin, Texas. So the question is, the brain teaser is, how much is he taxed on that extra $1,000 that he takes out? So the logical answer here is that for every dollar of IRA money that he pulls out, he would pay 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22%, right? The 22% tax. Simple enough, right? Well, wrong. Yeah, he's actually going to owe $407 in tax, a 40.7% federal tax rate on that income. And thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed, the real answer is that Bill is going to owe $407 on that extra income, that extra $1,000. Well, welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Bill Bush. I'm a financial advisor with Horizon Financial Group here in Baton Rouge. And I want to thank you for joining us today to learn more about taxes in retirement. And I want to assure you of one thing about today's presentation. I believe that you're going to be better informed about the challenges of retirement tax planning after listening to our talk today. Now, you may be wondering why, as a financial advisor giving a presentation about retirement tax planning. Well, from time to time, I present workshops and classes on various financial educational topics, such as Social Security, retirement planning, IRA planning, healthcare planning, among others. So the goal here is to always inform and educate the audience so you can understand just how critical financial planning topics affect you and certainly your family. So doing this presentation because I've seen many people make mistakes and pay more taxes in retirement than is really necessary. And so when that happens, it certainly makes our job here as financial advisors harder because people have less income in retirement and we have to find ways to make their portfolios last. So taxes can seem complex and certainly jargon-filled, even though kind of the underlying concepts, they're fairly straightforward. So let's just take a second to explain how this thing's going to unfold today. So our presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation problem, as you'll see here in a minute. So to help you remember what we're covering here today, we got a handout that's going to summarize all the main points of the presentation. So we'd be glad to mail you out a physical copy, or a little later, you can download it. It's going to be available in the chat section right now as a PDF, and it's called How Tax Planning Changes During 4 Stages of Retirement. It's a really good resource, 6-page resource for you to refer back to when you need it. Now, of course, you may have questions as we go along, and we ask that you hold those till the end, or you may even want to type them into the chat. We're going to try to get to a couple of those, but we're all going to be pretty tight on time. And we're also going to follow up via email on certainly any questions that we're not able to get to. So I want to mention at the end of our presentation, we do have an invitation if you'd like to meet in person to discuss anything you might have questions about when it comes to your individual situation, retirement and taxes. This is a complimentary one-on-one meeting that we offer. So if you'd like to discuss in private, maybe some of the issues that come up that are raised in today's presentation, we'll tell you a little bit more about that a little later. Also want to assure you, this is not a sales presentation here today. Anything you hear, well, you're not going to hear anything remotely close to a sales pitch at all. And what you will see tonight, again, will be summarized in our handout, which you can access in the chat section, or we'll mail you out a copy. So from time to time, we're going to bring up some poll questions. Please feel free to chime in. Here's poll question number 1. Do you believe taxes will go up in the future? Please answer A, yes, B, maybe, C, no, or D, I don't know. Do you believe taxes will go up in the future? Please play along if you would like. Yes, maybe, no, or I don't know. All right, if you could chime in there. Okay, so most people say yes. And we do know that the income tax brackets were actually shifted down back as a result of the 2018 legislation. Those rates are set to sunset in 2025. So yeah, very likely that taxes may go up in the future. Okay, for now, there's one other important point we need to make going forward. Everyone's tax situation is different. So you should always consult a qualified tax advisor to discuss your specific tax situation, especially about these topics that you see on the right hand of the screen, traditional IRAs. You know, you have to pay taxes on the distributions, or if you do conversions, at ordinary federal and state rates. Roth IRAs, money grows tax-free, and earnings may be withdrawn tax-free in accordance with IRS rules. And then there are state taxes. This presentation refers a lot to federal taxes. You still have state tax consequences as well. So make sure you check with your tax professional. And I'm a financial advisor. We don't provide tax advice. What we do help people with is to understand the tax code and other rules that could impact financial planning and investments. And then we help certainly develop a plan to take into account many of the odd things that people encounter, especially around taxes in retirement. So our goal here is to help you understand that the retirement distribution game, that is spending assets in retirement, is certainly much different than the accumulation game when you're saving for retirement. And chances are you've been in the accumulation phase of your life for several decades, and you've been working hard trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase. And that's called the distribution phase. The distribution phase has certainly new and strange rules that can catch people off guard. And along with those rules, there are often many changes in your own personal life that can have a big impact on your taxes as well. You know, I think of one thing, for instance, your children may be grown, and that means no more child tax credits. So your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. And if you've stopped working, you may no longer have the ability to stash income into a 401k or some other similar plan to manage your annual tax bill. And at some point, you know, you're going to start taking Social Security. And sooner or later, when you reach 72, you're going to have to start taking required distributions from retirement accounts. And, you know, the list just goes on and on. Many aspects of retirement are going to affect your tax bills in ways totally different from when you're in your working years. And so understanding what those consequences are and how they can impact you is certainly absolutely critical. So that brings us to the simple statement about the problem we're going to discuss here. And simply put, People often pay more taxes in retirement than expected because of a confusing system that treats various income types differently and contains hidden taxes and penalties. So in the accumulation phase, people build their assets and a lot of different forms. You think of stocks, bonds, real estates, pensions, 401ks, IRAs. Well, in the distribution phase, your regular wages or other earned income, they stop coming in. And so you have to take the money that you saved and use it to fund your retirement, which really could go on for decades with good health on your side. You could be in retirement 30 years or more. Well, that's challenging because you need to make informed decisions about the tax implications of tapping into different accounts, and that can be costly for sure. So in retirement, your tax rate can vary dramatically based on decisions you make, such as the timing and order in which you use different sources of money to pay for your expenses. And poor choices through misunderstandings or just not knowing the rules can result in people paying more taxes than necessary. So as a result, they can see their savings drop faster, and that can mean less to leave if you want to leave something to the kids or grandkids. So of course, we don't want that to happen and don't want that to be you. And the fact that you're here today, means that you're willing to work towards a solution, which obviously is an important first step. So because your tax exposure will change throughout 4 stages of retirement, you're going to need a strategy that anticipates, traditional taxes and possible taxes. Think of surcharges and penalties related to Social Security, Medicare, and other income sources. And that means you're going to need an informed, proactive plan that addresses how you create income in retirement. So the goal here is to introduce you to major aspects of that kind of a strategy and show you the challenges that we're all going to face, and then explain what makes up a workable solution to that retirement tax problem. The first step is develop an understanding of the types of taxes that you may face. And what I mean when I say taxes, using the air quotes, well, I'm talking about all the costs that can increase as your income does, including some that really aren't even called a tax. But to me, if the cost goes up as your income rises, it's kind of a tax in our book. You also need to understand that, the retirement expenses you'll face, and you'll need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions should occur. So getting this right will help you pay as low a tax rate as possible. All right, so before we go on, here we are talking about 4 stages of retirement that we're going to discuss. And these are kind of rough ranges as you look at the ages and the descriptions, and your experience can certainly differ from this. This is just a framework for discussing our topic here. But first, there's pre-retirement, the final work and save years. Let's call it age 50 to 60. Around here, we call it the runway decade, if you will, kind of that runway up to retirement. And so next we have the early years of retirement, maybe that 60 to 70 age range. The go-go years that are often referred to, people often have grand plans at this time, like traveling, volunteering, maybe starting new hobbies, got a lot of energy, working part-time, spending more time with family. And then the third point you see down there is the middle years of retirement, 70 to 80 or so, also referred to as the go slow years, which bring more financial decisions. I think about how to deal with required minimum distributions from your IRAs and other retirement accounts. And then finally, at the bottom, you see the later years of retirement when your health may not be as good. When you start thinking about, well, gosh, my legacy and estate, they often referred to as the no-go years. Things slow down, certainly, and those start around 80 years on up. So as you'll see, a wide range of issues that must be planned for, and each phase of this can get a lot harder than it seems because of this. Retirement is full of surprises. And even the best planning is going to divert from reality at some point. Our future, one future unknown, and you list some retirement surprises here, but one of the unknowns is inflation. We're certainly seeing that a lot this year. People tend to view their future costs in current dollars and don't always anticipate that those costs can grow with inflation, the rising costs of goods and services. Think back 30 years ago to the cost of, a gallon of milk or a gallon of gasoline or a visit to the emergency room. Now let's think forward, those costs today and where they'll grow over the next 30 years, while you're not working. That, in a nutshell, is inflation. Or, how about the second one here, longevity? Many people end up living far longer than expected, and that certainly requires more money at a time where it's difficult to work, maybe more difficult to work as you age. So, that age-old question, how long do you think you're going to live? Certainly longevity plays a factor. Many people also underestimate how much money they're going to need to maintain a pre-retirement standard of living when you look at expenses, and who wants their standard of living to drop? And then there are healthcare costs. That's the 10,000-pound gorilla. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which obviously keep rising. It's certainly one of the larger inflationary categories historically is healthcare. So now at this point, you may be thinking, okay, well, what's the first thing I need to understand about retirement and taxes? Okay, so here we go. Our first key, and it is this. You have to know what your after-tax retirement savings picture looks like before you actually retire. What do we mean by that? Well, it's because if you had $500,000 in your 401k or IRA, that balance isn't really $500,000 because the government has a claim on part of that money because the taxes were deferred. They'll get a share when you're forced to start taking required minimum distributions after you turn 72. Now, obviously, the higher tax rate that you're in retirement, the less your account is actually worth. There you see the 35% tax rate listed on the right and the 37%. So here's an example on this chart to show you the kind of the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year is what they use here at various tax rates. So the zero tax rate on the top, obviously the lower your tax rates, the more you get to keep. Simple in theory, but certainly difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your whole retirement. And just note the disclosure on here. This illustration is hypothetical. That 6% rate of return doesn't really represent the performance of any particular investment product. And of course, ordinary income taxes do apply when you're pulling out money from your IRA. So let's go on to the next thing. Now you may be thinking, okay, well, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay for my healthcare costs. But one thing you need to understand when creating your retirement tax strategy is this, that Social Security and Medicare actually have their own tax traps that you need to plan for as well. We're going to talk about that. So let me just take a quick swig as we prepare to talk about Social Security and taxes. All right, so here we go. Let's go back to Bill. We met at the very beginning from that tax brain teaser, and we want to understand why he paid such a high tax rate on that extra money he took from the IRA to go on the concert road trip, the Willie Nelson concert. So remember, Bill had $38,000 of IRA income. That's part of his adjusted gross income of the $56,525. You see it, the AGI, $56,525. And he had $25,000 in Social Security benefits. That's the left hand before the concert trip. Okay, that puts him squarely in the 22% tax bracket we talked about. He takes the standard deduction. Yet when he took that extra 1,000 IRA distribution, that $1,000, he got hit with nearly a 41% marginal tax rate, that $407 on that $1,000. So let's break down how this actually happens. And first, let's remember the only difference between the two scenarios here are that Bill has taken an additional $1,000 from an IRA, and you see that in the after concert trip column. He now has $39,000 in the IRA column. All right, so we move ahead and we see that by adding that additional $1,000 of actual income, it increased both his AGI by $1,850. So that means for every dollar, as you compare the AGI from the left to the right, it increased by $1,850 to $58,375. That means for every dollar of income he actually received, he's being taxed on $1.85. Huh? How does that happen? Well, here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your income is low enough, all of your Social Security benefits will be tax-free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. So Bill finds himself in that latter scenario. His current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that is $1.85 taxable at his 22% tax rate for every $1 of additional IRA income he actually receives. So if you do the math on that, it comes out to 40.7% real tax rate on that additional $1,000 of income. It's the so-called Social Security tax torpedo. You see it on the left. He got hit by the Social Security tax torpedo. It can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is important. All right, so let's take a look at another aspect of Social Security and taxation and how people approach retirement. Now, during the go-go years, that early year, right, some people retire altogether, but other people enter in kind of that semi-retirement, Sometimes it's a continuation of a previous job with fewer hours. Others use semi-retirement to explore maybe an interest in a new field, and others to pursue, volunteer work, non-paid work. But working in retirement can impact your planning and taxes in a number of ways, and some of those are good, some of those are bad, and some of those, quite frankly, downright ugly. So let's look at how working during those years can be a good thing. So chances are you've certainly looked into Social Security, what your benefit might be at various ages, but you may not know that your Social Security benefits are calculated using your highest 35 years of inflation-adjusted earnings. Well, what if you started working later in life? Or what if you left the workforce for a while, maybe to raise children? Or you may not have 35 years of earnings history. Suppose you only have maybe 28. Well, those remaining 7 years count as big fat zeros when they calculate your benefits. But there is good news. So earnings at any age can help you increase your Social Security benefit. And thanks to how Social Security calculates those benefits, replacing several years of those zeros with even modest earnings can positively impact your benefits. And by the way, we do have a webinar solely about Social Security on our website, horizonfg.com, under events. You can see that if you're more interested in diving down into Social Security benefits and how they're calculated. But now let's look at how working, even during your go-go years, can be somewhat bad if you're already collecting those benefits and unaware of Social Security earnings and that limit that applies prior to reaching what's called your full retirement age. And here's how that rule works. If you start Social Security, be it your own retirement benefit or spousal benefits, prior to the year that you reach full retirement age, for every $2 above a certain amount that you earn, and it's fairly low, it's $19,560 in 2022. So every $2 above that amount, Social Security is going to withhold $1 of benefits. Now, keep in mind, we're talking about earnings here, like a W-2 salary or self-employment income. We're not talking about pensions, interest, dividends, and capital gains. They don't count and won't reduce early Social Security benefits. So for instance, let's say that you earn $21,560 in 2022. That's $2,000 over that limit. Therefore, under the $1 withheld for every $2 earnings rule, Social Security is going to withhold $1,000 of your 2022 benefits. Okay, but those benefits are not truly lost. When you turn full retirement age, your benefit is going to be adjusted to make it as if you applied at full retirement age with respect to what they had withheld, with those withheld benefits. In other words, your benefit going forward at that time will be a bit higher. But also in the year you reach full retirement age, there is a separate, but it's a higher earnings limit than what you see there. Keep that in mind. All right, we've talked about the good, and that's the bad there we just talked about. So now you get to the ugly, and we're here today to talk about taxes in retirement, but there are other taxes you may face too. For instance, while you're working, you're subject to the 7.65% Social Security and Medicare taxes in addition to income taxes. So the self-employed, they actually pay twice that amount, 15.3%, to cover the employer's contribution. And keep in mind, those taxes don't go away if you're working past full retirement age, and even if you're collecting Social Security. Worse, if your go-go years earnings don't make it into the top 35 years, those Social Security taxes go into the trust fund, and it doesn't really increase your benefit. So you're paying the taxes, and it could possibly not increase your benefit. All right, time now to move on and talk about Medicare and taxes. But first, let's do another poll question real quick. And so here we go. A second poll question. What was the marginal tax rate in 1940, the top marginal tax rate in 1943? What do you think that was? Was it 94%, 97%, 7%, 23%, or 48%? If you could chime in there, what do you think the top marginal tax rate was back in 1943? Talking federal taxes. Okay, let's see what we got. Believe it or not, the top rate was actually 94%. Is that crazy? So yeah, it steps on up, but I think if you made over $200,000, that was the tax rate, 94%. Compare that to where we are now, the top tax rate is 37%. So, all right, now let's take a look at how Medicare and something that they call, you see it on the left, IRMA, the IRMA cliff, IRMAA, how that can impact some couples in the go-go years and beyond. So look, first of all, what is IRMA? IRMA. It stands for Income-Related Monthly Adjustment Amount. Income-Related Monthly Adjustment Amount. And the emphasis is on income because it is a monthly tiered surcharge. Again, kind of a tax, remember, kind of a tax, that is tacked onto people's Medicare Parts B and D premiums, but it only happens if you have income over $91,000 for singles and $182,000 for married couples. So I'm going to take a look at what this means kind of in action. So you see George and Martha here. They are a high-earning married couple, and both are Medicare B and D participants. IRMA surcharges affect income from 2 years prior. And so let's think about that. This couple was on track for $283,500 of modified adjusted gross income, Maggie, in 2022, 2 years prior. But on December 1st of 2020, George, he decided to sell a stock that he bought way back in 2007. So he bought it for $10,000 in July 1st of 2007. And he sold that stock for $11,000 in December of 2020. So that gave him a $1,000 gain that he was taxed on. And that he was taxed on the 15% long-term capital gains rates. Plus, he had an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. Well, that 3.8%, that net investment income surtax, that's just another tax that comes into play when your modified adjusted gross income exceeds $200,000 for singles and $250,000 for married couples. So it applies in their case because, as you see, the Maggie was $283,000. So he had to pay that additional 3.8% on top of the capital gains on that $1,000 gain. So George and Martha now owe $188 of tax on the gain from the sale of that stock, right? $188, 18.8% of the $1,000. Or do they? Remember, the definition of tax is a cost, any cost that increases as your income increases. So then George and Martha are going to owe more tax than $188 because the gain from the sale of that stock pushed them off the Medicare IRMA cliff. And that's going to cause them to pay higher Medicare premiums. And let's take a look at this, how this works. All right. Look at this Part B IRMA chart. And you'll see different tiers here. So the rows are single filers, less than 91,000 of modified adjusted gross income on the far left. Well, if you make less than 91,000, the 2-year look back, your total monthly premium as you go left to right is going to be $170.10. So each row is a different bracket. So what it did in this case, that extra $1,000 gain pushed their AGI into the next premium tier. Tiers moving on down, and that tier starts with $284,001. So now, instead of owing $340.20, which is that third row down, that's where George and Martha were on their monthly premiums, they're now going to owe $442.30 per month. That's an extra $102.10 per month times two, what for each person, $204.20. Annualize that now for an annual total. In addition, income-related monthly adjustment, Medicare Part B premiums, we annualize that $2,450.40. Wow. But it's not over because Medicare Part D IRMA charges are also impacted in the Medicare Part D. George and Martha are each going to owe about an additional $19. They moved from the plan premium plus $32.10 down a row to $51.70, so about an additional $19 there. On their drug plan, that's an extra $466 for the couple over the course of that year. So adding all those additional IRMA surcharges together for the year, George and Martha are each going to owe about $121 a month, or about $2,915 or $16 for the year, just because of that stock sale. Now combine that with the amount of the $188 of actual federal income tax they would owe for that stock sale. The total tax owed on the $1,000 of gain, this is whopping, comes to a total of $3,104. That is a tax rate of 310%. And that's crazy. So let me repeat that. $3,104, 310% real tax rates. They sold a stock for a $1,000 income gain. Stock sale was $188 on that tax, 15% long-term capital gains, 3.8% net investment income tax for high earners, made that the 18.8%. But that extra income from the stock sale triggered that new IRMA tier, moved them down, and that total IRMA surcharge amounted to the $2,916 for George and Martha. Just from that one move, the $1,000 extra in income triggered $3,104. Incredible. So you see, being pushed into a higher Medicare Part B and D premium range is actually worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket, even by a single dollar, only those last dollars are taxed at that highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you're pushed into that next premium tier. And it doesn't matter if you exceed it by $1 or $10,000. That's why they call it the IRMA cliff, pushed into that next bracket. So keep in mind, your IRMA payments aren't determined by how much money you made the previous year, but rather your modified adjusted income from 2 years ago. That's another tax planning thing that catches people by surprise. And certainly you can see the planning that might be needed in that case. Making sure, by the way, that you enroll in Medicare at the right time is a critical decision. If you bungle it, you're actually going to get hit by a lifelong penalty. To help you understand, let's take a look at Jim and Ann here, both 68. Jim retired at 65, Ann retired a year later at 66. But prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. So those are the facts there. So unfortunately, they didn't know they had to enroll in Medicare Part B as soon as Ann retired. Even though Ann's employer offers retiree health insurance benefits, those benefits generally are paid secondary to Medicare after retirement. But Jim and Ann didn't realize that mistake till it was too late. And thanks to the way that Medicare and their enrollment periods work, they weren't able to begin coverage until the next year. So you think about that. In the worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had some major medical need. But even in the best case scenario here, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe, get this, a 10% Medicare Part B base premium penalty, and they'll owe that for life. And you can see how much that equates to and translates into real dollars as you see the math here. They're going to owe $408 extra in 2022. And historically, we can estimate that premiums will likely be higher. So that 10% penalty will grow and grow in real dollars over time. So over the course of a lifetime, likely that could translate into a $10,000 mistake for the couple. And by the way, for simplicity's sake, we're assuming Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D, but just know there's a penalty for that too. So keep in mind penalties in Medicare that exists. So, wow. Are there other tax traps that we will face in retirement. We've seen Social Security and Medicare. They have their own unique set of rules and tax traps, penalties, if you will. But if you're like some who've looked at this presentation before, you may be asking, what else are we going to face? Well, the rest of what we're going to cover isn't like what we've seen with Social Security, the tax torpedo or the Irma cliff for Medicare. The public generally isn't aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. Before we get to that, our third key of the presentation, let's pop up another poll question. So here we go. Poll question number 3. Probably gave this one away, but let's do it anyway. What age do you begin RMDs? And those are called required minimum distributions. What age do RMDs begin? 70, 70 and a half, or 72? Everybody chime in if you'd like. Okay. And yeah, it's 72 is what the was recently changed to under the Secure Act. Before that, it was 70 and a half. So if some of y'all might have fallen in the 70 and a half age requirement, but right now it's 72. And there's actually legislation they're looking at right now that could bump that up even higher, where RMDs may start at 75. We'll see what happens there, but right now it's 72. Okay, that brings us to our third key now. So you must plan how and when you use taxable, tax-deferred, and tax-free assets to manage your income tax and tax brackets efficiently. You can't be haphazard about tapping your tax-deferred savings. Timing is everything. And so you got to plan carefully through all stages of retirement, and you might encounter some unintended tax consequences. Let's look first at addressing a question we hear a lot when doing retirement planning, and that is, well, what accounts to spend first? Okay. A common example here, let's look at Sam and Mary. They've been good savers, and as you can see, they're looking forward to spending their retirement years kind of traveling and seeing the grandchildren. So in addition to Social Security benefits, they have Sam's IRA, $450. So does Mary. She got $450,000. They each have a Roth IRA of $60,000 each. And then they have a joint banking account, $300,000 in there. They want to spend about $8,500 a month, or just over $100,000 a year. Where would you take the money from first? Yeah, that's a typical question we hear. So most people think, well, first take the after-tax money in the bank, and then take the tax-deferred IRA money, and then take the tax-free Roth IRA money. And that's kind of what's conventional wisdom. It's been promoted by certainly a lot of big investment firms for quite a while. Not a bad plan at all, but we know conventional wisdom may not always be the best approach. So not surprisingly, this topic has drawn attention of academic researchers specializing in this very thing of financial planning. They've conducted these studies and how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs, pensions, tax-exempt Roth accounts, and some of the titles you see here, some of the studies. And the research has shown that conventional wisdom approach for some may not be ideal. So an alternative approach. And let's look at that. And there are two key elements in the early years. First, this alternative approach used the taxable bank money for expenses, but also during the same period, accelerate IRA distributions in otherwise low income years, putting that money possibly into Roth accounts. That's what's called filling your tax bracket, the filling your tax bracket approach, which we'll take a look at in a minute. The alternative approach, gives you more flexibility to use that tax-free Roth money strategically down the line in future years. Does it make a difference? It could. So the academic studies, in this approach has shown to increase portfolio longevity. That is how long your non-Social Security assets will last before being totally spent. It could stretch them out maybe a couple of years. some of those studies show. The big takeaway here, of course, is that you got to plan all the way through retirement, especially around how you handle your tax deferred assets. And of course, as we mentioned before, make sure you see your tax professional for tax advice. So one way to help manage your income both before and during retirement is to utilize Roth IRA conversions. So a Roth IRA conversion, it's a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k into a Roth IRA. So in general, the amount that you convert is going to be added to your income for the year, and you're going to be taxed at your rate. So for example, Jill here in the gray box, she converts $100,000 from her IRA into a Roth IRA. She will have to add $100,000 to her income for that year. The conversion income is going to be taxed at Jill's rate. For that reason, it's recommended that prior to any conversion, you consult your tax professional. And the conversion doesn't need to be all or nothing. You don't have to convert the whole account. One helpful conversion approach that's discussed is what's called filling up the bracket. Often you may find yourself in the middle of one of the tax brackets. And here you see them all lined up in buckets. And you might have room to add more income without pushing yourself into a higher bracket. For example, in 2022, the 22% tax bracket for married couples filing a joint return, that goes from about $83,550 to up to $178,000. So if you file a joint return and your taxable income is $100,000, that means you could add another $78,000 of income without flipping over to the next bracket. And that may make a Roth IRA conversion make sense. So if you plan to convert a large IRA, this approach is often more efficient than converting the full amount in 1 year. Instead, you make just smaller Roth IRA conversions over a number of years, filling up that tax bracket each time. And this can help you reduce your average tax rate you'll pay on your converted money. Also spreads out your tax bill over a longer period. Now, Roth IRA conversions, those can be powerful in years when your taxable income is low, such as having, you might have a high non-recurring medical expense deduction in a particular year, or if you're a business owner, a low sales year as a business owner. It's also common for people who retire early and are not yet receiving Social Security benefits, pensions, or IRA distributions. They may have a very low tax bracket, making that a good time to complete a Roth IRA conversion in those pre-RMD, kind of those gap years. Okay. So this is a good time to spell out kind of the crux of things. You must know whether you're going to keep income below a bracket threshold to avoid bumping up to the next highest tax rate, or whether you're just trying to increase income to fill up the bracket to take advantage of that tax rate that you're already in. Some tactics you could use in managing income around tax brackets. Some other ones might include, withdrawing tax-free money from life insurance policies to keep income low, selling appreciated stock for low or no capital gains, taking distributions from IRAs or 401ks to take advantage of a lower tax rate. Remember those traditional IRAs and 401ks, those tax deferred. If you pull those out in lower tax rate years, that's an advantage as well. As we've seen, you could also consider partial Roth conversions to fill up lower tax brackets. All right. So there are also two other pre-retirement strategies to consider, and they don't apply to all people, but worth mentioning here. The first has to do with how you use a health savings account. This would only apply to people who are covered by a high deductible health plan, HDHP. The second has to do with small business owners and those who want to be extra tax savvy in saving for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim what's called qualified business income deductions, QBI. Both of those features of the tax code could be used to manage your tax exposure and provide pretty significant tax favored benefits throughout retirement. So if either or both of those apply, make a note of that. At Horizon, by the way, we serve as advisors on about 75 company retirement plans, and certainly would be able to help you out with that to consider what might be a good fit for you if you're a business owner wanting to start a company pension or 401k plan. All right, so we've seen throughout our presentation the critical importance of managing your tax deferred accounts because once you're over 72, you're forced to take those required minimum distributions, those RMDs, and that can be troublesome to your tax bill. But many people make charitable contributions supporting their favorite nonprofit with annual gifts. So let's take a look at how your RMDs and charitable giving may work for you with a little planning. So this is Albert and Shirley, who are in the 24% tax bracket. So by the way, now the standard deduction for a married couple filing a joint return for 2022 is, you see it there, is it's $25,900, but they're over 65, so they get an additional deduction, bringing their total standard deduction to the $28,700 you see there. So this means they will receive no tax benefit for any itemized deduction unless their total exceeds that standardized deduction, that $28,700 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from other sources, state and local taxes, deductible medical expenses, mortgage interest maybe, what happens tax-wise if they donate $5,000 to a charity? Well, they get no federal income tax benefit from making a charitable contribution because it doesn't help them exceed that $28,700 standard deduction there. That's not to say they, of course, shouldn't do it, but they should understand it's not helping them to save on taxes. So if you're over 70 and a half and you have an IRA or even an inherited IRA, there is another way to give to a charity than simply just writing out a check. It's called a qualified charitable distribution, or QCD. See it on the left, QCD for short. And let's just take a look at how this works and see why a QCD can be pretty powerful. First, some rules. Okay, if you're 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older, well, you both have an IRA in this case. You can both each make up that $100,000 qualified charitable contribution. So double that, really. Second, any qualified charitable distributions that you make count towards satisfying your required minimum distributions, which, remember, begin at age 72. However, when you make that distribution from your IRA, it has to go directly from your IRA to the qualified charity, or you can actually receive a check from your IRA custodian made payable to the charity. And third, and this is the odd part, even though you gave to the charity, you get no income tax deduction. So you say, well, why would you suggest a strategy where you get no deduction for giving to charity? And it is because of this. When you make a qualified charitable distribution, the QCD, the distribution from the IRA is never counted as income when you compute your taxes. So let's take a look at this and how that helps Albert and Shirley, who we talked about. Okay, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution of $5,000 at the beginning of the year. He deposits it into his bank, and he's done with his RMD for the year. Now, being charitable people, they want to donate $5,000 to charity. The end result is the charity gets the $5,000. Everybody understands that, right? But now let's look at that more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution is actually going to cost them a total of $6,200. You see it, that bottom line there. And why is that? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket. 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is actually $5,000 plus the tax bill of $1,200 or $6,200. So remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. All right, now let's see what happens if Albert and Shirley use the QCD. So to give the $5,000 to the charity this way, instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. And that satisfies Albert's yearly RMD because he's over age 72. Now, the charity is in the same position as before. They received the $5,000 donation. That's a good day. Albert and Shirley, they're in a better position. They gave the $5,000 to charity, even though they didn't receive a deduction for making their contribution. Their IRA distribution is excluded from their tax return, doesn't count as income. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to the charity is $5,000, a $1,200 savings over the previous example where it went into his bank account and then he wrote the check out, simply by knowing the rules and how to use those tax rules to their advantage. And they had to do it, and they did it all without ever getting a deduction. Just didn't count as income. Now, we all know that charity starts at home. Excuse me, let me take a little drink real quick. So I think the natural question to ask is, how does retirement tax planning figure in? And good question, because the government still wants its share of those tax deferred assets when you pass away. And like we've seen, how you set things up really matters, which gets us to our final key, number 4. And that is this: organize your assets for your family's benefit. Yes, estate planning still matters. Now, maybe you're someone who has managed to save up quite a bit in your IRA or 401k. You're pretty confident that you'll be comfortable in retirement and are hopeful that you'll be able to leave something behind to your children. In the past, we might have, we've recommended that because the right structure, your heir could withdraw that money throughout their lifetime, right? They could stretch it out, possibly decades. Well, that changed in December of 2019 with the passage of the Secure Act. So now beneficiaries of inherited accounts, with some exceptions, including spouses, by the way, but beneficiaries of inherited accounts now must withdraw the money within 10 years of the owner's death and pay taxes on that money. Again, there are restrictions. The restriction on what was called those stretch IRAs shines a light on how important tax planning is. Laws can change at any time. So you need to have a plan and revisit that plan regularly. So let's take a look at Pamela and Kyle as an example of choices beneficiaries have when they inherit those IRAs and no longer can stretch those distributions over their lifetime. All right, so the first scenario involves Pamela and her son Kyle. Pamela unfortunately passes away, leaving her full IRA, to her son Kyle. He is the only child and he's the sole beneficiary of this IRA. We know that Kyle has a maximum of 10 years to withdraw the IRA monies to meet his required minimum distribution rules. And Kyle likes regular distributions. So he elects to take equal distributions over the next 10 years. So if the IRA earns an average 6% rate of return annually is what we're figuring here, the payment would calculate to somewhere around the $54,347 you see there. And that's what he would take each year. Kyle would have that amount added to his income on his tax return, every year for the next 10 years. So that's one way. That's scenario number one. Scenario number two, think of this. Kyle does nothing for years 1 through 9, but he has to take the distribution in the 10-year window. So he takes the full distribution in year 10. And this second scenario looks a little different because he lost track of time. He's already reached year 10, and now he's required to take it out, right? And since it's year 10, full distribution all in 1 year, assuming the growth rate, by the way, that $400,000 IRA can now grow to as much as 716. You see there, 716. He's got to take the whole thing as a distribution in year 10 and pay the income tax on that amount. And that's going to push him all the way to that top tax bracket in year 10, 37%. Remember? Okay, but enough about death. Let's talk about long-term care now. And this is certainly not a long-term care presentation. It's about retirement and taxes. But believe it or not, there's some tax breaks associated with long-term care insurance. For example, long-term care premiums may be deductible as a medical expense at the federal level and also possibly eligible for deductions or credits on the state level. And on the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from those reimbursement style policies are tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit, which is currently $390 per day. But choosing how you pay for long-term costs can have a big impact on your estate and your heirs. Let's take a look at an example. In recent years, those non-traditional long-term healthcare policies that blend together long-term care insurance and life insurance together, those have been popular. And often the first inclination of the insured here is to tap the policy to pay for the long-term care costs. But sometimes that could be a mistake. And here's a look at Florence. So Florence is a widow. She qualifies for long-term care benefits and lives at home with in-home care. Her yearly costs, care costs, you see it there, are $60,000 a year. Florence's Social Security income, $20,000 annually. That covers her basic expenses, but not long-term care. She also has $400,000 in an IRA and a life insurance policy with a long-term care rider that will pay $500,000 to Florence's children upon her death. Now, alternatively, Florence could use up to $10,000 per month for long-term care costs under that policy. Any amounts used for long-term care are going to reduce the life insurance death benefit. So please note, this is just an example. It's not meant to represent any policy, but many long-term care life insurance hybrid policies do work in this fashion. So first, suppose Florence, is infirmed for 5 years, uses her policy to pay for those long-term care expenses. That's why she bought the policy, right? To pay for that. But here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. So the $500,000 policy is going to pay out $300,000. Remember, we talked about $60,000 per year over 5 years. Well, those were her expenses. The policy is going to cover that. That means her children will inherit tax-free life insurance of $200,000 because the long-term care, what it paid out, reduces the death benefit down to $200,000. And that's the remainder of what's left. Okay, so in addition, her children are also going to receive, she had the IRA, $400,000 in her IRA, which will be taxable to them when they inherit that. Okay, now let's suppose Florence lives the same 5 years, but instead uses her IRA money to pay for long-term care expenses. Florence still pays minimal income tax per year because she has those high medical expenses that are deductions, very high medical expense deductions. And now the kids are going to inherit the life insurance policy, which is worth $500,000 completely tax-free. as well as the remainder of the IRA money, which is $100,000. Remember, she was using 660 for 5 years. So that reduced the IRA by 300,000. So 100,000 remaining, of which will be taxable. So you compare the scenarios there, and really the ultimate benefit is sort of unknown because it does depend on Florence's children's tax rates and what those rates are. But it is kind of hard to imagine a scenario where paying for her care with 300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with 300,000 of tax-free money. In the second scenario there, preserving the tax-free money for the heirs and paying for long-term care with Florence's taxable IRA money. Just note a couple of ways to handle that in that situation, which pull on different tax levers. So you're thinking, well, here we are. How in the world are we ever going to manage this? And we're getting to the end of our presentation here. Let's bring it all together. One final poll question before we do this. What's currently your greatest concern regarding your retirement assets and your plans? Is it A, the recent stimulus and how that might affect my retirement? B, losing money in the stock market? C, running out of money in retirement? D, paying too much in taxes, or the final one there, being unprepared and unexpected for health care issues. So if you could chime into that. Final poll of the day. And I think a lot of these come up often, you know, as concerns as folks eye retirement or actually in retirement. All right, so let's go ahead. We started with that clear problem at the beginning that retirees, you know, often pay more taxes than expected because of this confusing system that treats various income types differently and contains hidden taxes and penalties. Let's do a quick review of what we learned in the 4 stages. So in the pre-retirement heading, we saw the importance of knowing and understanding your after-tax value of your retirement savings before you get to retirement. We also saw in those pre-retirement years, it's critical to consider your tax-deferred savings and, you know, start taking advantage of funding Roth accounts to fill your brackets if that's something you and your tax advisor decide might be worth doing. And that's something you could do in those early retirement years when you're in low tax years. We also looked at Social Security taxes, or Social Security and taxes. We saw that Medicare has its own tax-like structure that could push you off the IRMA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those go-go years. And that's because because starting really in the middle retirement years, you're going to be confronted with those RMDs. And we've seen the importance of planning your income needs before then and, you know, resolving those tax issues involved. Then we saw the importance of setting up your assets and managing them during the later years of retirement so you can preserve the most for your heirs, if that's applicable, and leave them with the most tax flexibility. And all those items together lead us to the obviously, you know, some solution for our original problem. And that is because your tax exposure is going to change throughout retirement, you need a strategy that anticipates how and when to tap your assets to cover your personal expenses, understands the range of taxes that you're going to face at those various stages, a strategy that manages your actions so you pay as little or as low a tax rate as possible. All 3 of those things certainly important. So by logging on today and joining us, you're indicating that, you know, you're preparing to leave that accumulation phase, saving for retirement, moving on to the distribution phase, whether that's sooner or later. And, you know, you're going to have to spend those retirement assets at some point. We've seen the distribution phase can be complicated, you know, more than just working and collecting a paycheck like it was in the accumulation phase. So managing your tax rate during those 4 retirement stages is certainly part of a challenge of retirement planning. And, you know, we've seen the cost of mistakes, and naturally we want to be efficient with our savings, and there are strategies to reduce your tax burden. But, you know, as with many things in life, it does take education, planning, and advice. And it's a lot to think about. You know, the tax code is complex, and the rules, as we've seen, are constantly changing. But what doesn't change in all that is that you need a plan. And golly gee, we've gone over time, but we'd certainly like to help you create a tax retirement planning strategy if you'd like. If you're interested in a one-on-one meeting with us, reach out to us. Email us at info@horizonfg.com. During that meeting, we can, kind of identify maybe what's on your mind, what issues in your family might stand out, and help prepare you for retirement. We are, attached with tax advisors that we could refer you to if you have issues that need some immediate assistance. But I think coming out of that meeting, just feel free to use us as a resource, and certainly want to be helpful in any way we can. So obviously we can help you with financial planning and investment advice as well. But regardless, when you leave that meeting, hopefully you'll feel better about your retirement planning needs and what you need to consider next. So just remember, info@horizonfg, that's the best way to reach out to me. And you can request your copy that summarizes everything, or if you'd like to reach out for a meeting. Also, just check out our website, www.horizonfg.com. Really appreciate you guys attending. Again, want to be a resource for you. Thanks so much for joining us. We hope this was informative and helpful for you. And if there's any way we can help, please reach out to us in the future. And that's going to do it. So thanks again for joining us, and take care. We'll see you soon.